Alternative routes and destinations. This slideshow explores the exit routes, liquidation events, and strategies for entrepreneurs to consider on the startup journey. If we think of the startup process as a journey, this map shows the alternative destinations that can be reached. In the context of this map, 0 means the founder has an earth-shattering invention or idea, but no company, team, business or business plan. Setting out from 0, the startup journey will conclude in one of only 5 realistic destinations. The first one is IPO. This involves registration of the shares that then become traded on the public stock markets. Following IPO, the owners are able to more readily sell their shares. This is a destination for our purposes here, as it represents an opportunity to exit for the shareholders. The company is no longer privately held and is now a reporting company subject to SEC regulations. The second exit is cash flow sale. This is where an acquirer buys the company as a profitable going concern with positive cash flow. The third one on the left is asset sale. This involves the merger or acquisition of a company that has not reached profitability or positive cash flow. Rather than buying the cash flow generated by the business, the acquirer is buying the product, the intellectual property, and perhaps the supporting team. The fourth exit on the right-hand side is orderly shutdown. This refers to a carefully planned shutdown when there's sufficient cash to pay all outstanding bills and avoid disputes with disgruntled creditors. The fifth and final exit on our chart here is bankruptcy. This involves a disorderly shutdown of the company, leaving some creditors unpaid. In the United States, this process is governed by Chapter 7 Bankruptcy Code regulation. Taking a startup from 0 to IPO can take decades, but Silicon Valley venture investors often aim to complete the process in 5 to 7 years. In boom times, when the public stock markets welcome new startup listings, companies merely 3 or 4 years old can sometimes become candidates for IPO. The costs of performing an initial public offering are usually at least $10 million, or 11% of the amount of funds raised in the IPO. So a company raising $200 million in its initial public offering could spend more than $20 million on the cost of the IPO itself. The banker's underwriting costs usually account for 7% of the funds raised, and the other costs to be budgeted include legal, auditing, accounting, and a variety of professional services. Following IPO, as a public reporting company regulated by the Securities Exchange Commission in the United States, the ongoing cost of complying with Sarbanes-Oxley and other regulations amount to at least $1 million per year, depending on the size of the company. The advantage of having publicly traded stock is the ability to sell shares on the public markets. This is appealing to investors and other shareholders, as well as the founding entrepreneurs. As discussed in the slideshow on valuation, a publicly traded company is generally able to justify a higher valuation than an identical company that's privately held. Liquid, readily tradable shares can be used by the company as currency to finance growth and acquisitions. In addition to the upfront and ongoing costs, a disadvantage of IPO is that it dilutes the shareholding of the founders and can take time to complete. Although some company shares are traded on the public markets, there's usually a lockup for 6 or 12 months following the IPO that prevents management and company insiders from selling their own shares. Even after the lockup is removed, the selling of shares by founders, employees, management, and other company insiders is heavily scrutinized by Wall Street investors and the SEC. Cash flow sale refers to the sale of a company as a cash-generating business. For every company that reaches IPO, there are at least 10 that are acquired in some form of merger or acquisition. So this is a much more likely destination for many startup ventures. Taking a startup from zero to cash flow sale can take as little as 2 to 3 years, but it depends on the length of time required to develop the product, establish the routes to market, and generate positive cash flow. When selling via brokers or investment bankers, the transaction cost of selling the company are often in the region of 10% of the funds raised. Like an IPO, legal and accounting costs must be added to the brokering fees. If the IPO market is buoyant, the valuation that a public flotation of shares places on the company can be much higher than the value that might be achieved in a cash flow sale. However, the IPO market is driven by Wall Street sentiment, and the value placed on a company or share can be somewhat unpredictable. The founders of a startup that's acquired in an M&A transaction can often exchange their shares for cash. They are not subject to the same lock-up restrictions they would face in an IPO. For this reason, selling the company is often a more appealing exit to founders than IPO. However, the liquidation preferences that are discussed in the slideshow on shares and the one on the capitalization table mean that the founders and employees have to wait in line behind investors when the proceeds of the company sale are distributed among company shareholders. As they hold preferred stock and founders and employees hold common stock, the investors often take the lion's share of the proceeds of a cash flow sale. Private equity funds play an important role in the merger and acquisition market, often acquiring small growing companies. This is one of the reasons why the M&A activity sometimes remains buoyant when IPO activity sinks. Not all companies that are acquired are cash-generating businesses. Corporate acquirers in the technology sector often buy startups in order to acquire their technologies, their teams, patents, and intellectual property assets. In the general world of business, the term asset sale refers to the structure of a transaction involving the sale of assets, rather than the sale of shares and other securities. However, in these materials, where we're focused on entrepreneurship, we're using the term asset sale to refer to the sale of a startup that has not reached profitability or positive cash flow. Rather than buying cash flow, the corporate acquirer is buying the core assets, the product, the intellectual property, and the ability to engage members of the core team. As the focus is on building a valuable asset, a compelling product, technology, or intellectual property, and it's not necessary for the company to build extensive sales, marketing, and distribution channels, the time scale involved in taking a journey from zero to asset sale can be somewhat shorter than the journey to IPO or cash flow sale, where it takes many years to build a fully functioning business. Assembling the team, building the product, and selling out in an asset sale transaction can be as quick as a couple of years. Where the capital requirements for taking a technology startup from zero to IPO or zero to cash flow sale are usually measured in tens of millions of dollars, the cost of building the product, testing the market, filing patents, and protecting the intellectual property can be an order of magnitude smaller. So companies involved in an asset sale often have raised only in the region of $1 to $3 million. The relatively small capital requirement is an advantage to the founders, as it means they're not diluted by large rounds of investment. As the common stock held by founders and employees is not dwarfed by large volumes of preferred stock held by investors, the founders often get to participate in the proceeds of an asset sale. A disadvantage of this asset sale exit is valuation, where a profitable business could be acquired for a price based on its financial performance and cash flow generating potential. A startup acquired in an asset sale is valued based on other metrics. One metric often used by buyers is a build versus buy calculation. The buyer calculates what it would cost to build the startup's products or technology assets in-house and bases the valuation on this figure. The startup can then negotiate a premium over the pure build cost of the corporate acquirer due to the fact that the startup's product is ready to market today, and the acquirer may miss the market opportunity by taking months or years to build a product of its own. However, the value of a startup acquired in an asset sale will be substantially lower than the price placed on a profitable, cash flow generating business. The vast majority of startup ventures terminate in some form of shutdown, so this is a popular destination on the startup journey. It's important to distinguish an orderly shutdown from bankruptcy, as covered in the next slide. Let's define an orderly shutdown as a carefully planned shutdown of the company while it still has sufficient cash to pay all outstanding bills and avoid problems with disgruntled creditors. The costs incurred include the state filing fees to dissolve the company, the fees charged by professional advisors, including accountants and lawyers, as well as the costs of paying off all the company's creditors. The advantage of an orderly shutdown is that management is seen to act responsibly. As a result, there's little chance of liability for management and the board of directors. It's a disadvantage, of course, that the investors lose their stakes, and shutdown certainly does not represent a profitable exit for the founders and employees. Bankruptcy is a form of disorderly shutdown, dissolving the company when it has insufficient funds to pay its creditors. Often the process starts when the company files for Chapter 11 protection from creditors. Chapter 11 creates an automatic stay, preventing creditors collecting on debts, and buys time for a company reorganization. If the reorganization is ineffective, the company can then pursue a shutdown under Chapter 7 of the US Bankruptcy Code. This involves selling off the assets in order to repay the creditors. There are costs associated with state filings and legal and accounting fees. Perhaps it can provide an opportunity for someone to acquire the company's assets at a fire sale price, to restart a new company, but it's difficult to find any advantage to bankruptcy as the destination of a startup journey. There are substantial disadvantages, though, to the founders, management, and the board of directors. The corporate entity usually acts as a liability shield for its owners, but often the directors and officers are required to guarantor secured loans such as equipment leases, and these individuals have to pay out of their own pockets for some of the debts left unpaid by the company. Non-payment of taxes, pensions, and state withholdings by the company, fraud and mismanagement during the period of insolvency can all lead to criminal charges for the officers and directors of the company and a somewhat tarnished business reputation. For people that relate to visual images, this island can characterize the startup journey. The challenge is to take the startup from zero on the left to one of the distant peaks: IPO, cash flow sale, or asset sale. The fastest and safest way of reaching the chosen destination is to plot out a set of milestones, generate momentum, and stick to the route. However, the path is very narrow and it's easy to wander off course. Climbing back up the slippery slope to get back on track takes time, energy, and at best slows progress along the route. Travelers that can't make it back up the slope are destined for the shutdown sea. The sea surrounds the island, indicating that shutdown is possible at all steps of the journey. If splashing into the shark-infested sea equates to a messy bankruptcy with angry creditors, making an elegant descent into a waiting boat might be equated to an orderly shutdown process. When embarking on any journey, it's very useful to have a target destination in mind. If you don't know where you're going, you have little chance of getting there. So when targeting a destination for the startup journey, there are only 5 destinations to choose from. It makes no sense to target bankruptcy or shutdown as destinations, so we can cross them off the list. This leaves only 3 possible routes that you could realistically select for your company: 0 to asset sale, 0 to cash flow sale, or 0 to IPO. Isn't our diagram missing an important destination? What about the notion of building a profitable business that survives indefinitely as an independent company, generating revenue and profits for its owners? A large portion of the businesses operating today would fall into this category, what we call here independent survival. While technology startup companies need exit routes like IPO or merger or acquisition, because investment is necessary to develop a technology-oriented product and bring the company to the point that it's cash flow positive. Outside investors, of course, need a return on investment. The rule of thumb in Silicon Valley venture investors was traditionally a return of 5x investment, 5 times the amount of money invested, over a period of 5 years. Investors are unable to generate these returns through dividends paid out of company profits. So the investors need an exit to convert their shares to cash or liquid currency and pay a return to their own investors. As we will learn in other slideshows, venture capital investors generally operate with 10-year funds. They look to invest in the first few years of the fund and then exit each portfolio company via IPO or acquisition in the final few years of the 10-year window. So for high technology startups today, independent survival is not really a sustainable situation because it provides little or no return to the outside investors. Huge cash investments are typically required today to develop the technology and accelerate the company along the route quickly enough to take a market leadership position and make it to IPO. Of course, a private business can distribute profits by paying dividends to shareholders, but it would likely take years, even decades, for investors to recover the cash they injected to fund the upfront research and development costs of a technology company, and even longer for them to see a positive return on investment. Without an exit route, these companies are like the living dead. The company is living, but the stock cannot be sold, so to all intents and purposes is dead. Investors are not prepared to wait decades for their annual dividend checks and provide a return on investment. Sooner or later, they're going to push the board of directors to seek a cash flow sale or IPO. Although it may be appealing to service companies, low-tech sector companies, and small mom-and-pop operations that are free of outside investors, independent survival is not a viable destination for technology startups that require investment in technology and take some time before they're able to break even. Startup companies can, however, remain in independent survival status for several years, waiting for the timing and conditions to create the opportunity for a push to IPO or cash flow sale. Startups setting out from zero, therefore, identify IPO, cash flow sale, or asset sale as target destinations. However, both cash flow sale and IPO involve building a fully functioning sales and marketing operation that generates sufficient revenues for the company to produce compelling profits and positive cash flows. The routes to cash flow sale and IPO are very similar. A candidate for cash flow sale is often a candidate for IPO and vice versa. Companies heading for each of these destinations follow very similar routes, so we can merge these two routes into one, at least for the first part of the journey. By a process of elimination, we're left with only two alternative target destinations for the startup journey: the long haul from zero to IPO and the short sprint from zero to asset sale. As we'll see later in this slideshow, backtracking and switching destinations en route can be very costly. As a general rule, longer journeys are more costly than shorter journeys, and if an entrepreneur is going to profit from asset sale as an exit, she has to contain costs and target asset sale from day one. Choosing whether to build a complete cash-generating business or focus on building a hot product is one of the first decisions to be made by the technology entrepreneur. This can also help guide management when making other decisions en route. Now let's take a look at some of the startup journeys that entrepreneurs may experience in Silicon Valley and elsewhere. We'll investigate the routes taken, the destinations reached, and the resulting impact on the founders, the shareholders, and the company's creditors. The direct route from zero to IPO is usually a win-win-win scenario for everyone involved. The company sets out targeting IPO, progresses smoothly through each of the stages, hitting all the milestones along the route, and reaches IPO without meandering or in any inordinate delay. The process involved various rounds of funding, but this direct journey is relatively quick and not excessively expensive. The IPO should generate a healthy company valuation, investors get a good return on investment, and even employee stock options start to represent significant value to the employees. A company setting out targeting asset sale can switch strategy and end up reaching IPO. Again, this is a welcome result for the founders, the investors, and everyone involved. In the zero to IPO diversion route, the company heads out for asset sale and soon starts to generate good momentum, quickly hitting its milestones and stepping stones along the way. It builds a valuable product and starts to think about preparing to sell the company to a buyer that has its own routes to market. No serious investment is made in sales and marketing, but orders start flowing in. The company likely receives an acquisition offer from interested buyers, but the decision is made to switch destinations, raise more funding, invest in sales and marketing, and build a viable standalone business. Distribution channels are established, and the route to market becomes productive. The company soon starts to generate impressive sales and turn a profit. The company successfully reaches its new destination, IPO. Well, by setting out on the route to asset sale, the company developed a culture whereby costs were kept under tight control. As a result, the journey to IPO was relatively inexpensive. The investors, employees, and founders find themselves holding company shares that were not excessively diluted by rounds of investment. When the lockup is released, the shares can be traded on the public stock markets. Shares and options that were purchased by the founders and employees for a few cents can be sold for tens or hundreds of dollars each. Zero to acquisition in a cash flow sale is a common route taken by successful startups. The company sets out heading for IPO, building a sales and marketing organization, as well as building a hot product. The company hits its milestones and starts to attract attention in the market. When the business turns a profit and starts to generate positive cash flow, management receives an acquisition offer. The directors and officers choose to accept the offer and sell the company. The company could be absorbed by the acquirer and disappear without a trace, or it could be operated as a standalone subsidiary that continues to deliver profits and positive cash flow to the parent. With positive cash flow, the company valuation should be quite reasonable. Investors, founders, employees, and all the shareholders should be able to cash out with a smile. In the zero to cash flow sale backtrack route, after hitting all its milestones and building a profitable standalone business, the company fails to make it all the way up the final ascent and reach IPO. Perhaps the company failed to achieve the financial performance results required by the public market investors, or the route is temporarily closed due to inclement conditions on Wall Street. Whatever the reason, the company doesn't make it all the way to IPO, and management decides to backtrack and sell the company instead. Assuming the company is generating positive cash flows, management should find a number of potential buyers and sell out for a healthy price. The valuation may not be as high as might be achieved through IPO, but the chances are that the investors get paid out in cash or shares that can be sold at any time, and the founders and employees are not forced to wait a year or so for the lockup to expire, as they would in an IPO. Assuming the sale price is reasonable, this should be seen as a good result for the investors, founders, employees, and everyone involved. If a buyer cannot be found for a cash flow sale or an asset sale transaction, the company's only other option is to shut down. An orderly shutdown can be achieved if management acts quickly enough to organize the shutdown process and pay off the creditors when there's sufficient cash in the bank to avoid bankruptcy. The creditors are pleased with this result, but it's clearly less than ideal for the investors, the founders, and the employees. In a bankruptcy situation, the creditors are left with unpaid debts, and none of the company's stakeholders are happy with the result. This diagram shows the most costly route to bankruptcy. This is a long, expensive journey. The company hits its milestones, raises seed venture, strategic and mezzanine rounds of funding, invests in building its route to market, generates profitable sales, and builds a viable standalone business. However, then it fails to achieve IPO. Perhaps the company struggles to hit its numbers, or Wall Street is resistant to new stock issues. Whatever the reason, IPO is not attainable, so management decides to make a left turn and look at selling the company in a cash flow sale. Perhaps discussions take place with a number of potential buyers, but the M&A process does not reach a conclusion. Management is unable to sell the company as a profitable going concern. The business then loses momentum. Perhaps the M&A discussions distract the management team and the company stumbles. Sales revenues fail to cover costs, and the company once again starts to burn cash. Management investigates the possibility of selling the company for its product in an asset sale. But these efforts also fail, and the company continues burning through its cash. Management struggles on, fails to raise new funds, and the company goes into a free-fall spiral. When it comes to shutting down, there's insufficient cash to pay off the creditors, and the company goes into bankruptcy. A long, expensive journey with bankruptcy as the final destination is something of a financial disaster for virtually everyone involved. The management team hardly walks away with an impressive track record. The founders lose several years of their working lives. All the seed, venture, strategic and mezzanine round investors lose their investment funds, and the creditors are left unpaid. Perhaps the most common route to bankruptcy sees the company heading out targeting IPO, hitting some milestones, raising some funds, but being unable to generate sufficient sales to turn a profit and build a viable standalone business. Management fails to cut or slash costs sufficiently to slow the rate at which the company is burning cash. It fails to target and drive toward asset sale, and without an obvious exit route, management fails to raise new funds. The company passes the point at which it has sufficient funds to carry out an orderly shutdown, and then ends up in bankruptcy. Again, the investors lose their stakes. The creditors' bills are left unpaid, the founders and employees have stock options that are worthless, and the officers and directors are responsible for a trail of management failures. Asset sale might not be as lucrative an exit as IPO or cash flow sale, but it can deliver profitable returns for the founders if the journey is direct and costs are kept to a minimum. In the direct journey from zero to asset sale, the company sets out targeting asset sale, so it raises a relatively small amount of funding and controls costs. The company builds a compelling product, a patent portfolio, and other appealing technology assets, then sells out to a corporate acquirer with existing sales, marketing and distribution capabilities. The acquirer gets a great new product to add to its lineup, a capable development team, and most likely disposes of the company's corporate shell. As the journey is relatively short and inexpensive, the investors achieve a healthy return from the proceeds of the sale. The founders and employees should come away with cash, stock options in the parent company, and other incentives to stay on board. In this journey, the company sets out targeting IPO, manages to build a valuable product or technology asset, then realizes the task of building a route to market could take many years and large amounts of investment. Instead of investing in building an expensive sales and marketing operation, management decides to sell out to a business that has these channels in place already. This exit can be profitable for the investors, the founders, and employees if the costs were controlled and not too much capital was invested along the way. Asset sale transactions usually take place at valuations measured in 6 or 7 figures, not tens or hundreds of millions of dollars. So asset sale is a profitable exit when costs are controlled and the minimum amount of capital is invested into the company. As investors usually negotiate liquidation preferences, enabling them to recover the funds invested before sharing the surplus proceeds of an asset sale with the holders of common stock, the amount of funds raised and the terms of the liquidation preference agreed at the time of the investment can have a huge impact on the potential returns for the founders and employees. If the proceeds of the sale fail to cover the capital injected by the investors, and the return the investors negotiated in the liquidation preference provision, the founders and employees receive nothing from the sale of the company. So asset sale could be a profitable exit for the preferred stock-holding investors, but an unprofitable exit for the common stock-holding founders and employees. The strategy for achieving a profitable asset sale requires minimizing the capital raised by the company, building a strong product or IP asset as quickly and efficiently as possible, and generating sufficient momentum in the marketplace to attract buyers, without spending too much money along the way. This is clearly a very different strategy from that of building a profitable business that could become a candidate for IPO. If asset sale is going to be a profitable exit, it needs to be targeted as early as possible, before too much cost is incurred and too much capital is raised. Entrepreneurs have to make the decision as to whether to target IPO or asset sale. This is an important decision and many factors have to be considered. The nature of the technology and the channel strategy have to be taken into consideration. Whether the company produces a complete product or a component can have a bearing on the exit strategy. A company that sells direct will have a very different outlook than a company that sells via OEM manufacturers, and these channel factors can seriously affect whether the founders want to build a business empire or focus on building a hot product. Of course, the personal objectives of the entrepreneur have to be taken into consideration. Some individuals are serial entrepreneurs wishing to build and sell a new company every couple of years. Others are looking instead to invest their whole career in a single startup endeavor. The business decision on heading out in the long haul to IPO or the short sprint to asset sale is very personal to the entrepreneur and specific to the products developed and the nature of the business. Now let's look at some of these factors in more detail. The selection of which route to choose is partly driven by the nature of the company's technology, how it's packaged and delivered to customers. Technology can be packaged up and delivered to the customer in various ways. In this example, the technology can be packaged to create a complete end-user product. The company packages up the technology into a product that's sold to the end user through various channels of distribution. Some technologies do not form complete products in their own right. The technology developed may constitute a product component that the company sells to another player that packages it with other technologies, forming a complete end-user product that's subsequently sold by another company downstream. Some startups are involved in creating technologies that form components of platforms. These platforms are then packaged with other technologies to create complete end-user products. Where the company's technology fits into this value chain can be significant. Each model has a profound effect on the strategy, so it's important to figure out how the technology will be deployed before selecting the exit route and writing the business plan. A technology company producing a complete end-user product may have a better chance of building a profitable business and growing into a candidate for IPO than a company that's producing a component of a platform. However, the choice is not that simple, and other factors have to be considered. Selection of the target destination is also driven by the channels of distribution required to bring the technology to market. As this slide demonstrates, the challenge of establishing a viable sales, marketing and distribution operation is often significantly higher than the technical, product development and management challenges faced by the startup entrepreneur. The channel often represents a choke point in the marketing process. There may be many inventions and ideas created by entrepreneurs, universities, research labs and corporations that result in compelling new products, and there may be a large market of potential customers on the right-hand side here. But the number of companies with appropriate channels enabling the product to flow to the customers from the developers may be relatively few. The reality today is that a large number of compelling new products fail to reach the market for lack of an efficient distribution channel. In a simple model, hot technology can be applied to create a new product and routes to market established to reach paying customers. A product development company may undertake the technology productization process in-house, using its own engineers and product designers. Alternatively, a licensing company may license the technology to another product developer that then creates the new product. When it comes to routes to market, as we discuss in more detail in the slideshow on distribution channels, there are various ways of getting the product into the hands of the customer. A company can deploy an in-house direct sales team, can appoint publishers, distributors, or sell via original equipment OEM manufacturers. A technology asset sale may represent the best commercialization route for many startup entrepreneurs. Rather than building the routes to market, the company sells the technology and the product to another player that has the channels and distribution in place already. In the complexities of the real world, one hot new technology may have several different applications, forming the basis of several different products and creating opportunities in a number of markets. An example may be a new fuel cell technology that's applied to form a variety of longer life, lower cost battery products. Large form factor battery products may appeal to the car and truck manufacturers. Medium form factor battery products may appeal to laptop computer manufacturers, and small form factor batteries may appeal to a market in the medical sector, perhaps for products like hearing aids. The channels of distribution necessary to reach the auto manufacturing market are very different from the channels required to reach the laptop computer market, and totally different from the distribution channels required to reach the healthcare market. So a new technology could create opportunities for a variety of new products, each requiring its own specialist channels of distribution and routes to market. These factors all play a part in whether the company is suitable to target asset sale or IPO. At the end of the day, the decision to build a profitable business and target IPO, or build a product and target asset sale, often comes down to a personal choice by the founding entrepreneur. An entrepreneur on a mission to build a publicly traded Fortune 500 company is sure to target IPO from day one, where an individual focused on building a hot new product and looking for a quick exit will likely target asset sale. The decision can turn on what the entrepreneur is looking to achieve. So here are the alternative routes and destinations of the startup journey. The actual figures are somewhat difficult to extract from the marketplace, but we do know that the vast majority of startup ventures end up on the right-hand side of the diagram, in some form of shutdown after the business fails. We also know that of the companies that survive, there are many more acquisitions, structured as cash flow sales or asset sales, than there are IPOs. Even in Silicon Valley, the chance of a startup venture reaching IPO is less than 1%. However, as we will learn in more details in the slideshow entitled 7-Point Travel Plan, entrepreneurs can increase their chances of avoiding the destinations on the right-hand side of the map by targeting IPO, cash flow sale, or asset sale, mapping out milestones along the route, and driving directly toward their target destinations.